Welcome to Diva's Two Cents, where we take complicated matters and we break them down for the masses. And as you know, this full year, this 2025 year has just gone like that. And what we have done as tax advisors is we've been looking at all these plans that we have put out there for you and giving you tax strategies all throughout the year. And today I am so pleased to have a special guest today. Her name is Terri Peters. She is a tax strategist, a tax expert, and we're going to be discussing today alternative assets, particularly the mineral rights, and maybe we'll talk a little bit about the 1031 exchanges. But these are tax strategies that we as tax advisors look and take it's like football, right? We take the ball and we throw them in certain directions so that you, the client, can actually, if you implement these, and I always use the word if you implement some of the strategies that we provide for you. Now, mind you, we're not attorneys, so we will put you in touch with the people that you need to connect with. You can build legacy moves with alternative assets. It's not just one size fits all for everybody. But I am going to introduce to you now Terri Peters. And hi, Terri, how are you?
Hello, Diva. Happy
The founder.
holidays.
Yeah, happy
Er,
holidays.
Thank
Terri
you.
Peters. Terri Peters, the founder of Tax Time Ledgers, a certified tax advisor in our network as well. As you know, we're always talking about what we can do for our clients. And Terri, I know that you're really good at tax strategies and talking about alternative assets with your clients. Now, we've been discussing mineral rights. Can you talk to me a little bit about why should anybody even care? I mean, why should people care about mineral rights in the tax world?
Well, mineral rights can turn a retirement account into a tax-free income machine. And if you understand the timing and the valuation, it really makes a difference. Most people think taxes are fixed, and they're not. So basically, the tax code rewards people who invest strategically, especially with the alternative assets.
hmm Okay, so what's the biggest misconception that some people have about mineral rights? Because when I talk about mineral rights to some of my clients, they're like, "Whoa, whoa, whoa, you're going a little deep here. What should what do you mean mineral? Are they going to dig under my home? I mean, what are you talking about?"
Well, I thought the same thing. And most of the people think that, mineral rights is only for the oil tycoon kind of people. But in reality, they can be conservative and extremely powerful inside a retirement account. So I think the biggest misconception, it isn't just for a certain group of people. Any of us can partake in it. And as we talk today, as we go through some question and answers, we'll lay this out so that you feel really comfortable about what we're talking about.
So, just as myself, as a tax advisor, we sit down with clients and we develop this plan for them, right? Where they see their financial picture in one graphic, right? Let's say the trifecta. Let's say we show them their operations and how they can, really maximize what they can do in their operational side from structure and from everything, from how they run their business, all the way to the passive side of their ledger to see in their portfolios what are some of the passive activities or even venues that they're using to build generational wealth, because at the end of the day, that's what we're trying to do. We're trying to leverage their money in the future so that they can do the best for their families, for themselves, right? So let me ask you this question. What's the biggest misconception that they have, other than they're thinking that you're going to be trying to sell them an oil well? What is the biggest misconception?
Well, when we're talking specifically on mineral rights, a lot of people don't realize that when you have a self-directed IRA, that's, you're not using your self-directed IRA to invest in stocks and bonds. That's when you're going to the big investment houses, right? That, those Charles Schwab, the Fidelities, the Vanguards. So when you want to go in alternative assets, whether it's doing promissory notes or investing in hotels or flips or mineral rights or any of those kind of things, you want to have a self-directed retirement account. So that's what we're specifically talking about, because you can't go to Charles Schwab and say, I want to buy mineral rights. You have to open an account at a self-directed retirement company, and then you get to choose what you want to invest in. So today, you and I discussed what we wanted to talk about, and mineral rights is a huge thing. And I've got an amazing strategy that I've been working with all year long with my clients, with several of my clients. And I want to share that with everybody because you can get into mineral rights in ways that you never even realized. I mean, there are things that you have to do. I mean, there are people you need to speak with. You need to talk with a tax professional to make sure that it fits your portfolio. You need to talk with a tax attorney. If there's certain transactions that need to take place that you need legal advice on, you need to meet the right company to do this with. I work with one specific company who I literally flew out in September and spent time with them and interviewed them and spoke with them at depth and went and looked at the oil wells and the mineral right areas where the packages are that they have. And, really wanted to make sure that I was with a company that we could trust because that's the thing, a lot of people don't trust oil and gas,
Hmm.
and I've been in it. My first husband was, in the oil and gas field and I lived in Colorado where there's a lot of drilling and, I met a lot of the people from Texas area and I wouldn't want to do business with those people. So I purposely sought people that to do business with in this area who I felt very comfortable with, that cared about my clients as investors, that were doing the best that they could, that they were extremely clear about what the costs are, what their profit is, what they're making when they sell these rights to people, whether it's working interest or mineral rights. And it's very important to do your homework. Look and see, are there, do they have a bad reputation? Do they have a good reputation? Talk to other people that are investing with this company. I spent an entire day with six investors. Well, three of them were part of the mineral rights packages that I was looking at. Three of them were thinking about getting into it, but very wealthy people that wanted to get in. Now, I got information in that whole entire day that I never had heard before, and I felt more and more comfortable with this. And then I decided, how do I bring this to the average client, the average tax person? And that's what we're going to talk about today.
Exactly. But let me ask you this. Why do you feel that mineral rights work well inside the retirement accounts, like the
Well, because
self-directed
it's
IRAs?
tax-free growth. I mean, the most number one important thing is tax-free growth. So when we have tax-free growth, you want to have it, we try to get, well, the strategy I'm going to talk about today, you want to try and get things out of your traditional retirement account and into your Roth. So using mineral rights in between going from a traditional and getting and converting it into a Roth, you want to have something in between that will be really helpful. The most important thing is how do we reduce and pay the least amount of taxes on that conversion? And so
Hmm.
that's what we're going to talk about today. And this, I've only
Okay.
found this in mineral rights. So I think it's something really important for people to hear and really important for us to be able to share because now that we know about it, we have to share it. So, but I have several clients doing this right now and we're having amazing savings. I mean, it's just I didn't even believe it at first, but I ended up spending time with some of the tax attorneys to discuss this and make sure it seemed almost too good to be true. But it's not. It's just utilizing the tax code, it's utilizing appraisers, and it's available for anybody who wants to do this.
Okay. So at a high level, how does the mineral rights and the Roth conversion strategy work overall? So I have a
Well,
Roth. So I have my
so
Roth,
you,
right? I'm
right.
sorry.
So basically, you buy mineral rights with your traditional IRA. And so the way appraisers work in the oil and gas field is at the very beginning, when you start production on these mineral rights, the production is low. It's just getting started. They're either just drilling the wells or they just finished them and they're just getting everything online. But production is low. And mineral rights are based on that production. They're not based on the future potential. They're based on what's producing now. So the company that I work with, they have tons of different packages, and some people are selling packages that are older. Then they also have newer packages that are coming out. So when my clients connect with this company, they're asking, what are your newer packages? Because we want to utilize the newer packages with the traditional IRA because when we get it appraised, it gets appraised lower than what we contributed. So say, for instance, you had $300,000 that you put in mineral rights in a traditional IRA. And then you
Hmm.
had it appraised. And say, like I have an example I can show you. Say it was appraised at $79,000. you're only going to pay taxes on the conversion from that traditional to the Roth on whatever that fair market value is, which is the appraisal. It's just like stock. If you bought stock for $100,000 and it went down to 70 and you decided I'm going to pull the trigger and move over to my Roth, the amount that you're going to be taxed on is that 70,000, the fair market value of the stock and the date of transfer. It's the
Hmm.
same thing with mineral rights. You get the appraisal because it's not publicly traded. So you don't have the stock market to look at, but you get an appraisal with an independent appraiser. And I have a list of like 5 appraisers that you can meet with, and you pay for your appraisal. They get you the appraised amount. You upload it to your directed IRA account, and that is the amount that will be used for that conversion from the traditional to the Roth. Now it's sitting in the Roth with significant savings that you're never going to pay tax on, right? Ever. And you're going to get your royalties based on the 300,000 that you put in because you're buying acreage when you're buying into mineral rights. You're buying a certain square footage amount. And so that doesn't change just because the value goes down. That square footage amount stays the same. So when you move it into your Roth, you still have, say you had 3 square miles or whatever, with the 300,000. I'm just using it for an example. And so and it went down to 79,000. Well, yeah, it's down to 79,000. You do your conversion, you pay the tax on 79,000. The other 200 something thousand are gone. You don't ever pay tax on that, but you still have those 3 square acres. So when you have your Roth, you're getting your royalties based on the acreage that you purchased originally. It's just like with stock. You buy so many shares of stock, the stock price goes down, you convert it to your Roth, you still have the same number of shares. And then as the stock increases in value, your value in your retirement account and your Roth goes up, and all your dividends are going into your Roth. Same thing with mineral rights.
Right.
The value
Exactly.
goes back up as it starts producing more. And the thing about mineral rights is they go on forever. So, I mean, that's part of your estate, and you don't have to do anything. Every month, your Roth is going to have a royalty check put in every single month. So I think it's an amazing way. Is there risk? Well, there's always risk. But right now, we have so many new technologies in place in oil and gas that they're pulling out more than they've ever pulled out with all the directional drilling and all that, and the fracking, and just it's very difficult to you're not going in with blinders on. You have geologists that specialize in this. I mean, the production is just so much higher now that they're not just picking a spot saying, well, let's see if there's oil here. They're going in areas where there's already wells, and then they're drilling more wells. And so it's really a beautiful way to make money and not have to sit there and do much work for it. I mean, you just look at your account and you see your royalties showing up, and then you report it on
Yeah.
your taxes
Yeah.
if it's outside a retirement account. If it's in your retirement account, it just increases the value in your retirement account. And since it's a Roth, you're never going to pay tax on what you put in, any of the growth or any of the royalties. It's tax free forever. So that's the beauty of it.
Right. So as you know, and I want to go on record here, we're not attorneys and we're not trying to sell you on any commodity here or anything, but we are talking about tax strategies that we utilize that you are able to utilize. And if it's implemented and there's a lot of ifs involved, so you have to do your due diligence. It's not something that you're here saying, you do need to talk to the attorneys, talk to the companies, do your due diligence, of course. But this is an avenue that's not really researched well and not utilized well, especially in retirement accounts. And some of the people that are doing it are really implementing and really getting gains. And it's because they know something that the majority of us don't know. They know that these are alternative assets that they can put in their portfolios if they do their due diligence, and they can actually leave a legacy for their family. And this thing will continue, as Terry said, forever and ever for your family. Now, why is timing and appraisal so important, though, early on when you first get it? Why is it so important to get that appraisal?
Well, the IRS used to say you had to wait 6 months from the time that you purchased the mineral rights to get the appraisal. Well, 6 months, anything could happen in 6 months. It could be really producing by that point. So they changed, I don't know why they changed it, but for some reason they removed that restriction. So as soon as my clients are buying into their mineral rights and they're the newer packages, they're getting it appraised immediately. and then doing the conversion because they want as much going into the Roth as possible. So the sooner you appraise, the sooner that you can do your conversion, the sooner that your earnings are going into the Roth side. Okay. Plus, the earlier that you get in on the appraisal, when you buy into your mineral rights, the lower the amount will be on the appraisal, which gives you a better conversion. So you pay less in taxes that way.
And that's because it's going to be based on the appraisal, not on what I pay, right?
Exactly.
That way?
Hmm.
Okay.
Yes.
Okay. That makes sense. That makes sense. Um, well, let me take it one step further because my audience is very curious. Okay. They will always ask the question, well, why this and not that? Why? Okay, we always talk about self-directed IRAs. I'm a proponent of that because I want to be in the driver's seat and I want to be the one driving that vehicle that's going to build generational wealth. So why should I put mineral rights in my back seat as opposed to going to the norm like what everybody else does, you know? And I know we're going to be talking about real estate because real estate is a venue that you can really build generational wealth. I mean, my real estate portfolio has helped me as well. But why mineral rights as opposed to that? What's the drawback or what's the catch here that some people should consider?
Well, I like diversification. So my clients, I have a podcast, double D triple T dot me, DDTTT.me. And on there, I have a very diversified group of people. I have somebody who's a hedge fund person who has, several, like 5 funds, and he's in Wall Street. That's publicly traded companies. So I have clients that diversify into that. I also have a promissory note, a person who does flips, and he's got an incredible story. And he's also on my podcast. And you can be accredited or not accredited to work with him. So I love that because it gives some of my clients that are just getting started, that don't have millions of dollars, that are just getting
Hmm.
rolling with their retirement accounts, and they want to get out of Wall Street or start looking at other things. And I said, well, promissory notes are a good thing. So I have a podcast that interview is amazing, and you'll get to meet the person that I really like, and I'm invested with. I'm not saying it's the only person. There's plenty of other companies, but this particular person is someone I'm invested with, and I like to share who I work with. But you have to have a self-directed account to be able to do that. So that opens that door. Well, then I have another podcast with a person who works with the oil and gas company that I went and visited, who I absolutely love. And he and I talk all the time about the different client situations that they have with their investors, and they're selling property and they want to get it into mineral rights. I mean, he had a guy who sold like a resort or something, and he had a lot of money and from that sale because he owned this property for a long time. But he also had part of it was the land, and part of it was the buildings, and part of it was real estate, and part of it was the actual business. And so the business didn't qualify for that, but we broke it up, the sale up into two things, and so two areas, and they were able to actually put part of that sale into mineral rights. So they alleviated having, because it's real estate. And so we're going to talk about this a little later with the 1031 exchanges, but they were able to alleviate a ton of taxes doing that. Now, for the average person, every time I have a new client, I ask, do you have stale retirement accounts? Do you have a retirement account from a previous employer or retirement accounts that you have set up that you haven't really been paying attention to? You have it sitting at Fidelity or Schwab or something like that. And it's just, you're not paying any attention to it. It's just growing. And almost always they say yes. And I said, well, would you like to do something different than what you have it in right now? I mean, you're not paying a lot of attention to it. You don't have a lot of time to put into, deciding where you want to invest at what stocks or whatever. If you want to try something different, this is a great place to try that. And so that's when they get interested and think, maybe we will try to put it into a self-directed account. And maybe mineral rights is a good fit for us because, again, you don't have to do anything. It's just collecting royalties. And so you could do it within or without a retirement account. It isn't just a retirement vehicle. It could go both ways. If you do it outside retirement, you get 15% depletion on any of the royalty income that you get. So you're already going to save 15%, you know, every year. If you get your royalty check, your 1099, and you've got your royalties, you've got $100,000 in royalties, you're going to have $15,000 right off the top in depletion. And then you pay tax on the difference. So that's outside. Inside the retirement account, it goes in the retirement account, and then it accrues the royalties there. But when we do the next step, which is what we're talking about today, getting it out of that retirement account, that traditional account, and converting it over to the Roth, that's when I say, let's get the appraisal. I wouldn't say get the appraisal if you're going to keep it in a traditional IRA and save yourself a couple $1,000s from an appraisal. Just let it grow in your Roth, and then you're going to be stuck doing your RMDs on it. You're going to be stuck having to, pull money out later and pay tax on everything, including the growth. But if that's what you feel comfortable with, that's fine. But if you want to move it into the Roth and understand the power of the Roth, the appraisal gets it at a lower value. That's when you convert it over to the Roth. It continues to get the royalties, whether it's in the Roth or the traditional, you get the same royalties, but you never pay tax on anything you pull out of the Roth. So it's a no-brainer to me. If you've got this stale retirement, let's get into mineral rights or at least a portion of it. Because, there's other things that people want to invest in as well, but I say diversify. So take a percentage of your portfolio, stick it into mineral rights, do the appraisal, get it over into your Roth, and let it grow tax-free. And then when you retire, you've got a nice little retirement thing there that you're not going to pay tax on. It's not going to show up on the front page of your tax return ever again. Plus, you reduce your RMD requirement because your RMD, your required minimum distribution from your traditional IRA, that
Mm-hmm.
is based on the prior year balance in your IRA. And then there's factors based on age and all that. So if you pull money out of the traditional and move it over into your Roth, you'll have less in the traditional so that your RMD is less. The goal to me is get everything out of traditional over to Roth, but some people like to have both. So this is a way to save taxes not only on all the earnings and any distributions that you take out in the future, but you also get to reduce what you're required to pay with RMDs. So there's like kind of a trifecta. You're getting money out of the market and putting it into a diversified asset. You have an opportunity to reduce future RMD. You have an opportunity to reduce future taxable income. And you get to take advantage of a great tax strategy where you get the appraisal, and the appraisal is lower than what you invested. So that money between what you invested and what the appraisal is, that's never going to be taxed ever. That's not just deferring taxes. That's literally alleviating taxes.
Right, right. And some people listen to us and say, "Well, what are they talking about? You still don't understand it." How would they get a hold of you? I know you mentioned your podcast, but how do they get a hold of you, Terry, if they wanted to explore more in this area?
Well, if you go to my podcast, that's the easiest, double D, triple T dot me. So it's ddttt dot me, me. On that link, you'll also see a link to my website. So you can come onto my website, you can see what I'm about and see who I am, and you can schedule a discovery call where we can hop on a call. I don't charge for this call. I just want to make sure that we're energetically connected. What you need is what you're looking for, what you need is something that I can fulfill for you. Just
Hmm.
kind of discuss how I work, what you have going on. And if I feel like, we are a good fit, and if you feel we're a good fit, I'm going to invite you to a comprehensive consult. And that's where you're going to pay. And you're going to sit on a call with me, and we're going to use Zoom, and we're going to go through, we're going to draw out everything that you have at this very moment. And then we look at that, and I use Mark Kohler's trifecta, and we look and see what you have on the passive side, what you have on the operational side, making sure you have your revocable living trust set up so that your assets are protected and you're not stuck going into probate if something happens. And then we
Right,
look at
right.
that, and then that's when we start fine tuning. And that's when I ask you, what are your, what are your risk? How do you feel about risk in this or that? And we kind of talk about what the opportunities that are available and how it's worked with some of my other clients, how it works with me. And then I will sit on a call. I'll introduce you to the people that are doing these things that I recommend. And we get on a call together and we talk.
Hmm.
I don't just, hand you off and say, oh, you figure it out. I'm going to sit on that call with you. And we're going to talk to
Hmm.
these people and we're going to ask the questions. And, when you feel comfortable, you can make that decision if you want to move forward. If you do, then I'll help you get those accounts set up and I will help you transfer the money. Basically, I am the implementer for Mark Kohler's strategies. He talks about the big picture and everybody gets all excited, but you need to find that tax person who's literally going to sit next to you in the front seat of the car and we're going
That's what I
to
do.
implement these strategies.
Yes, that's exactly
Yeah.
what we do, ladies and gentlemen, for all of you listening here. You keep hearing me talk about how I'm the quarterback, but this is exactly what we do. We will help you get what you need through the
Yeah.
avenues that you need with as little risk as possible. There's risk everywhere. You've got to do your due diligence. We will not allow, neither Terry nor myself, allow you to get involved in something that you're not comfortable with, that you do not understand because I won't. I won't. And I know Terry has a lot of integrity as well. We take you to the line. We will never let you cross that line because we've got a really a fiduciary responsibility to all our clients to do the right thing by them no matter what. So if you're more interested in this, do your due diligence, listen, learn about it. There's so much out there, so much information out there about mineral rights. The IRS is has a plethora of information in the tax code. And I know people don't like to hear that there's a lot in the tax code for you, but there is. I love the tax code, and I know that Terry does as well because we refer to the tax code all the time. A lot of things that you may hear on TikTok, on Instagram, on just Facebook itself may sound too good to be true. You need to do your due diligence no matter what. We are not attorneys. We're not here to sell you anything. We're here to give you informational. This is all educational, informational stuff that we're providing for you today so that you know that there are alternatives out there. The self-directed IRA has been out there for a long time. I know Terry knows Matt Sorensen. I know Matt Sorensen personally. He is one of the founders and one of the head of the self-directed IRA business that we talk about all the time because they work, they have integrity. So at least I can say that honestly. What are your thoughts, Terry? Am I going off on a tangent here? But I really want people to understand that in everything, in any type of an investment, there's risk. It's not a cookie cutter for everybody. Not one size doesn't fit for everybody. You've got to sit with an advisor, with a tax advisor that takes a look at your whole picture, that not only takes a look at your whole picture, but plots it for you and shows you which way it will go if you even steer in a different direction. Terry, I'm glad that you did talk about the revocable living trust because that is the foundation. That is where at least I start all the time. And I know there's a lot of discussion as to, well, what trust is good and what trust isn't good. But just think about it. If you don't do anything, right? What's going to happen, Terry? They don't do anything at all. Same old, same old. Next year, they'll be looking at people talking about year-end tax strategies, and they'll be in the same boat, right?
Well, you're very true. It's the whole thing is I get clients all the time that say, well, my other CPA didn't do this. And it's like, well, I worked for those CPA firms too. And everything was a red flag. And everything was, no, you can't do this. I learned from Mark Kohler, I'm not going to say no right away. Unless it's fraud, obviously I would never do anything like that. But let's see if there's a way. I hear what you're saying. Let's see how we can make this work. Now, sometimes we have to move over here and do something different, but a lot of times there's ways to make certain things work the way that you want to have them work, but you just don't have a lot of people that know this. That's why Mark Kohler's certified tax advisor program has been instrumental to me. But going back over to talking about Matt Sorensen, yeah, Matt's amazing because he put together this wonderful business, directed IRA, and I've been working with him for 3 years, and so have you, Diva. And I have
Hmm.
so many clients that have accounts separate. You could set up an LLC inside your retirement account, and then you can just pick whatever, investments that you want to have. I mean, there's rules you have to follow and abide by, but you can actually be the driver of your own race car there. I mean, you can go on crypto, you can,
Yeah.
like I said, promissory notes, you can buy rental property
Yeah.
in there. I mean, there are rules, and you want to talk with somebody who understands and is comfortable with this to make sure that you don't make any mistakes and do something that could cause a problem later. But it's not that hard. You find somebody, Mark Kohler's got a whole area on his website that, it's not just Diva and I. I mean, there's plenty of us that are certified with these tax strategies. I just have a different way of dealing with people. I'm kind of like, hey, this is what we have set up. This is what we can do. Here's a game plan. You get a copy of this in a PDF. Carry this around with you as you are having dinner or waking up early in the morning or can't sleep in the middle of the night. Start drawing on it. Tell me, like, come back to me and tell me, I want to try this. I want to try that. We are constantly fine tuning with my clients. I work with them all year long, and it's just a beautiful relationship. I love anything that comes from the heart. So when I'm working with somebody, I know that I am looking out for their best interest. I do not like anybody messing with my clients. So I like to be on the attorney calls. I like to be on the financial advisor calls. I like to be on the directed IRA calls. I like to be part of all of it just because I'm going to see questions that maybe you don't know, and I'm going to listen to things. I can't stand when somebody sells something to my client. I'm not a salesperson. I'm like right in there as if it's my own investment. I asked all the questions, and I want to make sure that my clients have all the answers and they feel comfortable. And if you don't know something, who are you going to ask but somebody who's like the one-stop shop? And Diva, I think you do a similar type of relationship with your clients, but I call myself the one-stop shop because I'm not just a tax advisor. The tax return's like the report card. I actually am more of a business partner. We look at what you have. I learn what you're comfortable with, what you're not comfortable with. I have clients that come from banking that now are all of a sudden getting into working interests in oil and gas, and they never would have done it 2 years ago. But now they're like, okay, I've done these different things. Things are looking pretty good. I'm feeling pretty comfortable. Terry's teaching me about these other things. I'm willing to try something different. But it takes time. You have to build a relationship. And listening to Facebook Reels, that gets you in the right direction. But you're not going to call these strange people and just say, oh, yeah, I want to invest with you because it could be a scam. I mean, I've gotten on some of these calls with some of my clients who hear all these things on these reels, and I'm like, make an appointment and I'll hop on that call with you. And almost every time I just look at the guy or girl who's talking, and I'm sitting there like, do you sleep well at night telling people about this? What about this, and this, and this? You're forgetting, certain aspects.
Yeah, they
If you,
forget. No, they leave things out. I mean, they leave
Mhm,
so much out. And now
mhm.
I'm accused of giving a little bit too much, I guess. And I'm glad you said that you get on those calls as well because I do too. And I had somebody ask me once, why do you get on a call with an attorney to just set up an S corp? Why do you do that? That's so simple. Well, I mean, they could just do it themselves. And I say because sometimes your client, and I'm a realtor too, so sometimes when they come looking for a house, they tell you they want a colonial and they end up with a tutor, right? Because they just don't know what they want. And sometimes they say, well, I want to start a company. I want, and I think the LLC is the way to go. I want to start this. And then during that attorney call, I hear them say other things that, bring up like, oh, wait, hold up a minute. Hold up a minute. You never said it was going to be a partnership. You said you wanted just to start a company. So the different structures, and it's very important to have everybody involved. I call it the bail, the banker, the accountant, the insurance agent, and the lawyer, right? Bail, because they're going
That's
to bail
good.
you out.
That's
You need a
perfect.
team. You
Yeah.
need a team, Terry. You need a team. So yeah,
And you
thank you.
need you need somebody who's going to be on top of all of it. The insurance person is not going to talk to you about taxes. See, the tax person is the best person because everybody says, "Well, talk to your tax person, talk to your tax person." So we're the best person to orchestrate the whole kit and caboodle. So I want to share a graphic, and then I know
Sure,
we
go
were
right
going to
ahead.
talk about the 1031, but I actually have a
Okay, that's
call
okay.
coming at the
Okay,
top of
that's
the
fine.
hour. So let's hop
That's
on
fine.
another call and we'll just
We
focus on the
will.
1031s because this is something that did an extensive amount of research on, and I want to make sure that I share this information with others because um, not everybody wants to stay in a rental property. And I found a way to be able to get out of that rental property, but still stay in rentals. So, well, royalty
I'm
type
glad you
rentals. So
said
you have
that.
real estate above the ground and real estate below the ground. So that's what mineral rights are.
Yeah,
It's
yeah,
real estate, but it's a below the ground. So
yeah.
let me, if you don't mind, I'd like to share the
Oh, I don't
graphic
mind
with
at
you.
all. And while you get that, I am going to tell you, I'm glad that we are going to have another segment on the 1031 exchange because there are rules to everything. Okay, rules to everything and full transparency. I think I'm able to share certain things because of the fact that I have made some of those mistakes in the past. I did a 1031 exchange once. I missed a deadline, a stupid little deadline that cost me
Oh my
thousands of dollars.
goodness.
So yeah, that's the first thing that I would look at when I look at someone who says they want to do a 1031 exchange. Let's follow the rules so you don't make those mistakes. Now, Terry, I think
Exactly.
can you shrink that a little bit or move it over? Let's see. Or maybe I can do it for you.
I think it needs to be moved on your side.
Okay, hold on. Let me see. Let me see. Okay. What do you want to share
That's
here?
perfect right there. That's good. That'll explain it.
Okay.
So basically,
Okay.
this is just a little graphic to show, like on the first part that says self-directed traditional IRA on the top left, you see The self-directed IRA, you've got $300,000 in a traditional IRA. Okay. So now you're going to take that $300,000 and you're going to move it, or you're going to invest it in mineral rights. All right. So you have a $300,000 investment in mineral rights. Now, oh, it kind of moved out of the way a little bit. There you go, right
Yep.
there. So yeah, that's better. So then all right, so you have your $300,000 mineral right investment in your self-directed traditional IRA account. So now you go get that appraisal. That appraisal comes in at $79,000. Okay. So let's see, that's going to be 21, that's 100, so 221. All right, it's $221,000 less than what you invested. Now, I've never seen it come this huge of a difference, but it really does explain it. Can you shrink that a little bit more, or it got too big all of a sudden?
Which part got big?
Just bring the whole graphic so that so we can see it. It's getting too big. You don't need to move it around.
Okay.
Just make it smaller so the whole graphic stays on there. But I'll just keep going through. So it
Okay.
appraises at the 79,000. So you say, okay, so you go to your directed IRA account that you have your traditional investment of 300,000 in, and you upload the appraisal for $79,000. And then you fill out a paperwork that says, I want to convert from my traditional IRA over to my Roth based on this appraisal. So then you're only going to pay tax on that $79,000, what the appraised amount is. So that other $221,000 difference between 300 and 79,000, that is totally gone. It's never going to be taxed ever. And so now that you have that $79,000 sitting in your Roth, the value in the Roth, now you're going to be getting your royalties into your Roth account. So if they decide, at some point at the end of the year, 12/31, they want to have it revalued every year, you can always have a revaluation if you want. But right now, you've got the $79,000 sitting in there. You've got the same acreage, you bought 3 acres for 300,000. You've got 3 acres for 79,000 sitting in your Roth. All your royalties are going to go into your Roth. All that income comes in. And then when you're ready to retire, you're never going to pay tax on any of it because you already paid the tax on the conversion. Once you convert it into the Roth, any growth after that is tax free. Any Roth contributions that go into it is tax free. So you don't have to pay tax on this ever again. And so you're basically setting up a gold mine of tax free income. And like I mentioned before, if you pulled $300,000 out of a traditional IRA, say you had $1 million in your traditional and you moved 300 out into mineral rights, you still have 70% sitting in your traditional. It's not like you could do whatever you want. You could diversify it into something different. You only took out 30%. So you've got 30% working on royalties and growing in this Roth with that extra 221,000 that you just saved tax on that you're never going to pay tax on. And now you only have 700,000 sitting in that retirement account. So then when they calculate your RMD, your required minimum distribution that you have to have on a traditional IRA, you don't have to have it on a Roth, but you do have to have it on the traditional. Now you have 70% of what you had the prior year. So now you're
Mhm.
going to have a lower RMD as well. So it really hits you in the tax world in so many different aspects. You get the reduction, the permanent reduction in the valuation when you convert. You have the royalties going in the Roth now, never paying tax on it. And you also have the reduction in the RMD, which nobody talks about. But I think that's an amazing opportunity for people to save on taxes. So I call this a little bit of a trifecta, but I really do like the power of the mineral rights in a retirement account.
Awesome. Well, thank you, thank you, thank you, thank you. So, what's the big takeaway that the listeners may want to understand about everything that we've talked to them today? Give
Well,
us a quick
I want to say
runaway.
that taxes are not fixed. So it isn't just putting your numbers on a tax return and then that bottom line number. With the right strategy, you can legally shift income into tax-free environments. And the best way to do that is with a Roth. And one of the vehicles that makes the Roth really powerful would be mineral rights being converted into a Roth after having an appraisal.
Oh, perfect, perfect. And as I always say, nobody changes doctors because there's a new doctor in town. Take some of this information to the person that is advising you in any which way. Talk to them about it. Do your due diligence. Do your research. Check out Terri Peters. Call me as well. I mean, whatever you'd like to do. Like we said, we're not attorneys. We're just here. We're quarterbacks for you. We're here to look out for you to build your generational wealth so that your children can inherit these things, so that their children can still have royalties coming to them long after you and I are both gone. Right, Terry?
Well, not only that, but you work hard and you build your portfolio for your retirement. So, I mean, we tell my mom, spend every penny. We want to see a zero at at that account when you're gone. Because, yes, some people have the legacy. They want to build all this up for their family for later. Some people just want to have a nice, comfortable retirement and be able to travel and do the things that they can't do while they've been building. So, this is a great way to be able to save on the taxes, be able to have a very comfortable retirement because once you have everything in your Roth, you don't have any taxes on that. So what does that mean? Well, when you have your Social Security, the lower your taxable income is, the less you have to pay. Remember, you have to pay either 0, 50%, or 85% of your Social Security.
Right.
So the less income you have, the less chance you are going to have to pay 85% on your tax on your Social Security, or 85% of your Social Security pay taxes on. So, I mean, there's so many different facets that all lay into this simple little strategy. So, yes, it's not only for your legacy, but it's also for you before you die. So, just more food for fodder. And like you say, Diva, these we're experts in this area, so we get a little overboard on all the different areas that it could save. But I hope that you take away from this that it isn't just one thing that this is affecting. This is like 5 or 6 different things that it affects. And if you have the right strategist that understands these strategies and is willing to educate you and help you be able to make decisions by giving you the information, the good, the bad, that will help you move forward, you've got, you're purposeful. You're planning and you're being purposeful, and you will be blessed for that. You are a good steward of what you have.
And we will serve you pancakes. Stack them. Stack one strategy
Yeah.
on top of the other. And before you know it, you've minimized what you have tried to do. Everything you tried to do.
Mhm.
Terry, thank you so much. I love you dearly. Thank you so much for being here. Next episode, we'll do 1031 exchanges for everyone because it's important and it's a very good strategy, especially I look at the 1031s more on the real estate side because that's where what I've been really delving into. But we can talk about 1031 exchanges on the mineral side, on the alternative assets sides as well.
Well,
Okay.
you can actually because they're both real estate. So it's
Yeah.
just like a
Yeah.
regular real
That's true.
estate into
Yeah.
mineral rights. So it's
It's
a
a mineral.
beautiful
Yeah.
strategy. I'm excited to talk about it. But yes,
Yeah.
if anybody has any questions, reach out to Diva, reach out to me. I would love to just invite you to listen to the podcast so that you can
Yep.
at least get
Yep.
some information and an interview style so that you can see what else is out there. So double D, triple T dot me and see where it leads. But thank you, Diva, for giving me the time to share this
You're
great
welcome.
strategy. I love you too.
I love you too. Take care.
Okay,
And for
bye.
those of you guys out there, that, my friend, is Divas Two Cents.